let's talk about what we're going to talk about today. There's going to be three parts to today's presentation. The first is just a reminder, is our key themes for 2024. We began doing this a number of years ago, where we lay out our key themes at the beginning of the year. So far, we haven't had to do a course correction in mid-year. The ideas that we plan to talk about throughout the year have come true from what we said in January we thought would be the most important ideas, and I think we're going to be able to continue with that today. The second part of the presentation is the market recap, and you'll see that the headline is fairly calm until just now. Things have become a bit more interesting. But at this point, it's all good news in terms of what's happened so far in the third quarter. And then the last part, really, it's going to be about the second half of the presentation, is our market outlook. Looking into the future is always the part that I find to be the most interesting. We're going to talk about the Fed put versus volatility. And today, as we're recording this, we're seeing a great example of the Fed put in action, which is to say, we're referring to an options trading technique whereby you can sort of get the result that you want out of the markets. The Fed essentially owns a put on the market, or owns the ability, more simply, to get the markets to move in a positive direction. And so with interest rates as high as they've been for as long as they've been, our Federal Reserve now owns within its capability the opportunity to lower interest rates and make many parts of the market cooperate and do better in terms of their expectations, and frankly, what we're all looking for as investors. So we're seeing that in action today, and we'll continue to see that play out for the remainder of the year. So that's really good news for anyone that's an investor. So let's go ahead and jump into things and just do a reminder of the key themes that we're looking at for 2024. And the first one is that a domestic political crisis may test the markets. And this has to do with the fact that divisions within the U.S. are widening. We saw an assassination attempt on one of the presidential candidates. That has not tested the markets directly, but the game's not over yet. And hopefully we'll be able to keep the country together, despite the fact that we're seeing these widening political positions across the U.S. The second key theme is that geopolitical shocks may test the markets. And again, we've seen the shocks so far. The world has stayed together, but things are not over in the Middle East. You could argue getting worse. Certainly things are not over in Ukraine. You could argue getting worse. And we are nowhere near the end of tensions between Taiwan and China. You could argue that it's getting worse there. So far, the markets have been resilient because they've been more concerned with the Fed put and what's going to happen with interest rates. But these first two risks could manifest themselves in the form of a shock. We just all need to be prepared for some increased volatility within all the capital markets, stocks and fixed income. The third theme, volatility among individual stocks, is something we've been seeing play out throughout the year. One of the reasons for that is corporate America adopting AI in rapid fashion. The use of artificial intelligence is making some companies more productive. It's leaving some companies behind, but it's definitely changing the landscape and the ability for companies to compete. It is now extremely common, even on a good day, to see some companies within the S&P 500 drop 10 or 15% in price, and sometimes even on a bad day, see other companies go up 10 or 15% in price. So if you have a lot in one stock, you may have noticed that. If you're diversified, you may not have, but it definitely is posing a significant risk to folks that are not diversified. And then the last part of our key theme list is this idea of a private market revolution. And I don't use the term revolution lightly. A year ago, we talked about how it could be a great time to invest in private markets, and that actually continues to be the case. Pricing is down, venture capital in particular is challenged, other parts of the private markets are challenged. Folks that participate in that industry and have cash to bring into deals speak of getting some of the best deals they've ever had. What I'm specifically talking about here, though, is that are new ways to invest, and you're going to see this show up more and more, even in the near future, I think, with BIP Wealth, where we can use investment vehicles that allow us to essentially put as much money as we want into private markets, and then in the future request liquidity when we want liquidity. If you're a financial planner trying to get a client to the right asset allocation, we've always been frustrated by the fact that we could do that almost instantly with public markets, but it took a long time to do it with private markets. Well, that's going to be changing with this new type of vehicle, this new way to invest, whereby we can adjust your asset allocation to be more optimal for you within a very short period of time. So very much a game changer and really coming at the right time if you're also looking to pull assets out of the public markets and add them to the private market. So those four key themes continue to stay in place, and we'll be talking about those more and more as we get through the end of the year. Now let's talk about what's already happened in the markets. And we're going to be pretty quick through this because this was dated June 30th. And as I said at the beginning, everything's gotten even better since then. So let's just take a brief look at the timeline of events for the second quarter. And there's really just a couple of things to point out here. Of course, you see that the markets were just very calm, more calm than we have a right to expect as investors in the stock market. But there were two headlines there at the beginning of the second quarter that I really want to speak about. One is that Japan began to intervene with the yen because it was sliding relative to the dollar. And this has everything to do with interest rates and currency support. What it was signaling was the end of what's known as the Japanese carry trade, meaning borrow cheaply in Japan and invest at a higher rate of interest almost anywhere else in the world, certainly including the U.S. And this is important because this action was telegraphed at the beginning of the second quarter. So if you might remember, a few weeks ago, the markets became extremely volatile, and the headline you read was that this was because of the end of the Japanese carry trade. My point here is that we knew this was coming. This was not new news. It was not a big surprise. And I just want everybody listening here to take with a grain of salt whatever you read as the headline for today when the markets move. Oh, here's the new big news. The copywriters are just making that stuff up. There's a copy editor at CNBC that makes a few phone calls and says, why are the markets so volatile today? And somebody gives them an idea, so they write the headline. But I think it's just important to understand that that's not always accurate. We also saw headlines: slower hiring in the U.S. boosts the hope of a late summer rate cut. Well, we saw this coming. We had been hoping for weaker labor markets because the markets had just been too tight. And so again, on the day where we had a lot of volatility 3 or 4 weeks ago now, where the market fell pretty dramatically, one of the reasons given was, because the employment market is getting a little bit softer. Well, we knew that was coming. It really had to happen. We've been talking about it all year. So again, don't believe the headlines. Now, as luck would have it, that dip in the market that had everybody worried for a few days had a number of financial outlets calling for that recession that, the recession they've been calling for more than 3 years that's never happened. They've even pulled all of those predictions back in already. So if anything, this little chart of what happened in the second quarter just gives me the ammunition to criticize the way the financial media will attempt to explain whatever's going on in the market in any given day. Looking at benchmark returns for the second quarter, I'll tell you to ignore some of this if you're interested, at least in the current data. So if you want to just focus for a moment on the year-to-date numbers, well, the fixed income index is negative. Now, our clients have done substantially better than the index because we have not taken the kind of risks that are in the index. But just take that year-to-date number and add between 3 and 4% to that, and that's where we're at right now. If you look at the global equity index and you look at the year-to-date number of 10.28%, you might have noticed that when you pull down your own quarterly portfolio report for the end of Q2, take that number and add between 3 to 4%. Again, it's a good day today, but that number is even better now. So if you thought these numbers were pretty good news to be halfway through the year, It's even better now as we're plowing our way through the third quarter. So every number that you see in here would be significantly better if we were printing those numbers today. So really, really nothing but good news, and even the paltry returns of the fixed income index are in fact a little bit better than you see right here. Breaking down what happened within the second quarter. Again, so much of this has changed. I'm not going to dwell on it. You might notice that emerging markets did particularly well for the second quarter, but some things were up and some things were down. Again, if I could print it all right now, it would be nothing but green arrows. Diving into some of the details, I do have some very interesting news for the U.S. market. You see for the second quarter that large cap growth stocks were the best place to be, and smaller stocks and value stocks were not. Well, since the end of the second quarter, that phenomenon appears to have reversed. So far in the second quarter, the overall U.S. stock market is up, as I've said, but what's happened is that the excess returns of many large growth stocks, meaning usually technology stocks, has been reversed. In fact, there's a number of technology stocks that are down a bit, whereas small cap stocks and value stocks have done particularly well. So if you're diversified, you might not have noticed this phenomenon. If you've got too much in tech stocks, maybe there's something you're doing on your own, you might be feeling the pain there. But a big reversal of what have been the winners and losers within the U.S. stock market. But again, if you're diversified, you can just know that it has gone up since the second quarter. I can really tell the exact same story for international developed market stocks, but there is one little wrinkle here. When we're showing you these returns in the top right quadrant, you'll see that we depict them in two different ways. And the dark gray bars are for dollar-based investors. So unfortunately, that's everybody here on this call. What's really happened is those foreign currencies that you're invested in when you invest overseas in the stock market have not done so well. The currencies have depreciated. So the returns were not too bad in the foreign stock markets, but the currency effect meant that for dollar-based investors, the returns were not so good. But there is a silver lining to that. When we say that foreign currencies have depreciated, we're also saying that the US dollar has appreciated. Now, that's really important for our current economic environment because an appreciating US dollar means that our inflation is falling. We can buy more things from overseas with the same dollar than we could have at the beginning of the quarter. This is just one reason that we sent out some messaging to our clients. You probably saw it with the invitation to this webinar where we said inflation is over. Inflation is behind us now. In fact, there's been some news since this was printed that has confirmed that that is indeed the fact, that inflation is down. That also gives the Federal Reserve more license to go ahead and finally lower interest rates. Emerging market returns really looked terrific, but once again, you can see the effect of currencies in there. That strengthening dollar that brings inflation down for us did mean that despite the overall good news, we didn't quite keep up with the return that investors would have seen if they were investing with their local currencies. And so we were having a little bit of Olympics withdrawal as we were putting this slide deck together. And so I just felt like it would be fun to give the gold medal to Turkey for the second quarter. But of course, there's also a lesson behind this. What I'm showing here is the difference in returns for different country stock markets all around the globe. And Turkey got the gold medal. Mexico came in last. I think it'd be a little bit hard to craft the story to explain all of these differences. And this is just one quarter, but look at how dramatic that difference is, more than the 30% gap between Turkey and Mexico here. You see the global equity index in the dark blue, and you see the US in green. We did a little better than that within the US. My point here is really that if you're a diversified investor, you are dodging so much of this volatility that's out there. But anybody concentrated in just a few stocks, or anybody concentrated in just one country, not being diversified, might not be having quite the smooth ride that you're having. So now we get to turn our attention to the future, the part that I think is the most fun to talk about. The headline is the Fed put versus volatility and the Fed's ability to dampen volatility by lowering interest rates. But let's kick off this section by showing you what I'm calling the medium-term forecasts for all the big economic issues of the day. Now we're circling 2025, that's next year, and I'm going to show you what the Congressional Budget Office, the Office of Management and Budget, what the Federal Reserve all predict our numbers will be. And so the top row is real GDP growth. And whenever we use the word real in finance, that means over and above the rate of inflation. So the Congressional Budget Office is expecting real GDP growth next year to be 2%. And while that sounds like a small number, you know, they're projecting that inflation measures will be a little bit above 2. So the number they're thinking we're actually going to see is somewhere around 4.1 to 4.3% in nominal terms, which is not bad at all. If you look at the Office of Management and Budget, it's similar. You look at the Federal Reserve, it's similar. And so my point in showing you these numbers is to really let you see that nobody is predicting a recession at this point. And so when a number of major financial institutions panicked 3 or 4 weeks ago with the brief stock market downturn and said, now we're finally going to get that recession, I think they did investors a disservice and probably caused some people to sell out of the stock market right before, just 2 or 3 days later, the market began a huge rally that now has us in much higher numbers than we were before that pullback. So I hope none of the folks listening to this call panicked and pulled out of the stock market. Certainly, we wanted to reinforce the idea that the Federal Reserve is ready to come to our rescue, even if the markets were to take a dramatic dip. And so as you look at the top row, GDP growth, you look at the next 2 rows where we define inflation differently, CPI versus personal consumption expenditures. Even if you look at the unemployment rate, what we're seeing here is quite a bit of stability in all of these agencies' predictions. And I don't want to get my hopes up too high, but if the Federal Reserve is going to lower rates the way they should, we may find ourselves at year end, regardless of who gets elected to be our next president, where short-term rates are lower than long-term rates. We have what we call a normal yield curve. Inflation is modest. Economic growth is there. And we just have everything that we'd be looking for as investors to feel confident about being invested in the stock markets, being invested in the fixed income markets. It's been nearly 2 decades since we've had what I might call a normal situation, but we're right on the verge of having one here with a strong economy and all the financial indicators looking really terrific. So fingers crossed the Fed will do what it's taken so long to do and help to put us there. If you want to pay attention to how our economy is doing all along the way, just let me remind you of this. GDP is not the go-to number. By the time we get a GDP report about the prior quarter, the economy has already moved past that, but we know the number's wrong. And then we get the update, the revision, and then we get the next revision, and by then nobody cares because we're all looking at more current data. That current data is the weekly economic index. So it's a little bit more bouncy, a little bit more noise in that number. But when we look back over the past, it signaled a recession before GDP did. It signaled a recovery before GDP did. And so you can just watch that number week to week if you like. Go into your browser and just search for weekly economic index or just WEI. And you can grab that real quick at any point in time if you ever get nervous about where the economy is going. Let's talk about inflation. Now, many of us have become a bit addicted to getting the next inflation number. And let me just for a moment suggest that we might not all want to be surprised if we start to see some negative CPI numbers at some point in the future. It is a little bit bouncy, but that being said, CPI is not even really the best inflation number to look at. The Federal Reserve, as you might recall from a few slides back, looks at something called personal consumption expenditures, PCE. But here's just one reason that CPI is not the best inflation indicator. CPI has within its constitution something called the owner's equivalent rent. An owner's equivalent rent is 27% of CPI. Well, what the heck is owner's equivalent rent? Well, remember that the CPI number is an attempt to come up with an inflation number that works for everybody. But the reality is 66% of American households own their own home, and I'm sure that number is even larger for our clients as it typically would be for a more affluent slice of America. And so what happens with OER as a component of your inflation measure is that it assumes we're all renting, or at least it assumes that 27% of the relevant inflation measure should go up when rents go up. Well, if the price of your house goes up and you put it out to rent, that would go up. But inflation is often something looked at as something that hurts us. And so your own personal inflation exposure doesn't go up just because your house is worth more. If you're renting, it goes up a lot more than the CPI number suggests. But again, it's meant to be an average for everybody. What I'm showing here is that since way back in the early 90s, owner's equivalent rent, that's in blue, has gone up faster than CPI. So CPI has been overstated for a long time, and in particular over the last 2 or 3 years compared to what it should be if you own a home. If you're renting, it's probably been understating. So again, the audience here is important, but it's just a pretty big criticism about CPI. It's the best they can do because they're trying to come up with a measure that works for everybody. But owning a home or not owning a home is a very big deal. And if you own a home, then inflation has been far less than stated. Let's talk a little bit about employment. And I see lots of data about employment. If you'd like to see lots of data about employment, I would encourage you to go to bls.gov. That's the Bureau of Labor Statistics. And I pulled together some data here that can be a little bit harder to get to. I used the Federal Reserve Economic Database graphing program to do so, but here's what I'm showing you. The blue line is job openings. And I put in parentheses for humans because there's more and more jobs for AI out there. The red line is not just the normal unemployment rate that you hear about. The red line is for unemployed plus discouraged. See, if you're looking for a job, but you haven't been looking for the last 4 weeks, you're not technically unemployed right now. But we want to include that. We want to look at unemployment plus discouraged. So maybe you would accept a job if offered, right? That's part of the definition of discouraged, but you haven't sent out any new resumes. You haven't made any phone calls. You haven't gone for any interviews in the last 4 weeks. So let's add those together to come up with the true unemployed number. And what I'm showing here is this gap. And we have the opportunity to see, have we ever had that gap before in history? Well, we had that kind of gap right before the pandemic hit in late 2019. Remember, it is called COVID-19. And that began changing the world very rapidly in 2020. But we still have right now, despite everything that you might hear, this overabundance of open positions. And it's closing, but my point is we could use a little weakness in the labor market. As long as there's more job openings than there are unemployed, you kind of have to feel like you're going to have economic growth. And I would contrast this with what we saw right at the end of the Great Recession. In 2009 and 2010, we we had way more people looking for a job than can find jobs. But now it's the flip of that, and that gives me some confidence that the economy is going to continue to grow for the foreseeable future. I wanted to bring some really timely information to the discussion about employment real quick, because I think it reinforces something that we've been talking about really for the last year and a half, and that is the possible effects of AI on inflation and on the job market. And what I'm showing here are two different job categories. And the first one is information jobs, or you could just say IT jobs. That's the one in light blue. And what I'm graphing here, really just over the last month, on the horizontal axis is the employment change. And what we're seeing is that there was a big reduction in the number of jobs in information technology. And that's a really big deal. If you're reading the headlines about layoffs, my guess is most of those headlines are going to be about Google laying off workers and Microsoft laying off workers and other big tech companies laying off workers in the thousands or tens of thousands. And so they're pretty highly paid workers. That's the vertical axis. And you can understand why companies might be trying to replace some of those if they possibly could. Now, contrast that with the sort of magenta colored circle where we've seen the biggest job additions, and that's in private education, but it's really coming from healthcare services. Why might that be? Well, we're all getting older, right? And so as we age and you look at the demographic profile of the United States, you can see that there's a lot of folks that are moving into the later stages of life now. You need more healthcare workers, more healthcare services to take care of those folks. And so really two dramatically different stories. But again, I think affected by AI. Now, might eventually healthcare services be augmented by AI? It certainly could, but there's no part of the economy affected more immediately than the number of jobs out there in information technology. And folks might not realize this, but there's a lot of work that gets done in information technology that is very bespoke, very customized, very one-on-one. And as companies figure out ways to use AI to get rid of that very expensive way of writing code and doing these other things, they're doing so. So moving on to the next slide, and again, talking about employment. What I'm doing now is I'm really just trying to arm you for some of the headlines that you're going to be hearing. What I'm showing here is a graph we've never shown before. It's the participation rate, meaning are you participating in the labor market? If any of you have ever received the phone call and taken that survey from the Bureau of Labor Statistics, you'll know that the first thing they ask is, do you have a job? And the second question they ask is, well, do you want a job? If you answered no to the first one. Well, if you're not looking for a job, then you're not participating in the labor market. Now, this graph goes all the way back to 1950. And what we're seeing here is that the participation rate for men, that's in green, has been falling for the last 70 years and is going to continue to fall. And so it's amazing how high it was when we were a much, much younger country. So that continues to fall as life expectancies go up and as we age. Now, back in 1950, the participation rate for women was very, very low. But as that changed, it drove up the line in blue, which is everybody. But now they're going down at roughly similar rates. And so the total is going down at a similar rate. We've known that that was going to happen. And I don't think it matters who's the president. I don't think it matters what else happens in the markets. We're going to see participation rates fall. And again, we've known this was going to happen. It's been happening for a while now. It's only going to continue. It's almost all just a function of demographics. Now, here is a little bit of data that could change that. In fact, probably has changed that to some degree. And I'm reminded of stories I was hearing 10 years ago where there was a company that identified that there were a number of stay-at-home moms that were professional accountants and just looking for a way to participate in the workforce, part-time or full-time, but were constrained by the demands of motherhood and the need to be at home for at least part of the day. What you see on the left here is a graph of workers responding to a survey of how much they wanted to work from home. And what you see is that about 17.5% of all workers surveyed had no interest in working from home, not even for a day. Whereas you had about a third of workers saying that they would prefer to work from home every day, and then the numbers in the middle. Now, there's other data I'm not showing. It turns out that it is the youngest workers and the oldest workers that prefer to have the most work from home days. Workers that have entered the workforce more than 10 years ago or have been there for a while find that to be less appealing, but you can see the data right there. On the right, however, is what the market is currently offering. And so no work from home days is about 38%, and all five plus days per week is at 22.5. It's really kind of surprising to me how close the match is, but it's not perfect. So as companies figure out how nimble they can be, how nimble they want to be around this particular issue, we could see the participation rate jump up as more companies adjust to what workers are looking for, or we could actually see the participation rate fall if the gap grows between what workers are looking for and what companies feel like they can offer. So we could see the participation rate moved around by issues such as this. But as we said before on the last slide, no matter what, we do expect the overall participation rate over the coming years to decline. I've spent more than a decade talking about a pretty boring yield curve. Here's what interest rates are. They're all very near zero, but for the last few years, not so much anymore. So let me just show you what's in the top middle of this page. What we see in the highest gray line there is the last print of interest rates. That's still pretty accurate today. Then we see where we were at 90 days ago in blue. And then in the pale green, we see where we were at a year ago. I thought it would be interesting to put on here where we were at even farther back 2 years ago, and that's what's in red. Well, there's something that all of these yield curves have in common. And just as a reminder, a yield curve is the going interest rate for a particular term of bond when those are U.S. Treasury bonds, so the safest security in the world. And what we see is that these lines are never smooth. So 2 years ago, the market expected interest rates to be 3% because it's the market, the highly liquid market, that sets any interest rate out there that's past just a few months. But the Federal Reserve was still keeping rates very low. And as they stubbornly kept rates low and stubbornly moved rates up just a little bit at a time, that's the overnight rate we're talking about, inflation took off. And because the Federal Reserve caused this almost runaway inflation and responded so slowly to those pressures, we saw the overall yield curve move up. Well, the situation we've been in now for the past year is that interest rates were too high. Short-term rates were too high. The Fed, acting too late to raise them, was now acting too late to lower them. And so you have the market saying, we know when a year rates are going to be lower. We know exactly what's coming. But again, the Fed was slow. You see this disjointed looking yield curve. Whenever the yield curve isn't smooth, again, over the long term, it should be short-term interest rates are a little bit lower. Medium-term and long-term interest rates should be a little bit higher. Whenever you see it not look like that, you know the Fed is too early or too late in its actions, and the market knows eventually it's going to have to catch up. So this has presented a great opportunity for us to invest on that short end of the curve. And frankly, we dodged some of the trouble that let's say folks vanguarding their portfolio or indexing their fixed income portfolio have had to deal with. I'm hopeful that by year end, what we're going to see is that short-term interest rates are perhaps around 4%. Maybe they won't get there right by year end, but by mid next year, long-term interest rates are up higher than that because of economic growth. And we're actually in what we would call a normal yield environment. I say normal, knowing that we've not really been there ever for maybe more than a minute, just here or there, for the last 2 decades. So that would be great news for investors if the line does not have that kink at the end of it. The Federal Reserve finally gets on board with what the rest of us seem to know. So here's a graph with a lot of information. I could do a full hour on this and I won't. Let me just leave you with this. I'm graphing 3 things. So the line in blue is the chances that we're about to have a recession. And where is the blue line right now? According to the Fed's own data, there is a 0.16% chance that a recession is imminent. If you look back over this long history that I've graphed, and I've shown you this data before, that line tends to move before we actually get into a recession. There's no hint of that right now. The other thing I'm graphing here is the federal funds rate in red. And if you want to take the time to look through this, what you can see is that, the Fed is always a little bit late. A recession has started and they're slow to lower rates. The recession's over, they're slow to raise rates. This goes back to my thesis that they go too far and they're always late. And then just if you're curious, you can see in the green line, what was GDP doing? So eventually we get to the point we can go back and show you what GDP was at any point in time. And even when it's been doing great, the Fed has been slow to kind of bring interest rates back down to a normal level. They tend to overstimulate when it needs to go up by lowering rates, and then pull the reins back too much when they need to bring things down, and do it for too long. And you could even argue cause these recessions. So I'll let you all go through that on your own, but I just wanted you to have the data. If you're looking for somebody to blame for some of the troubles that we've had for the last few decades at least, but really longer than that, I think the Federal Reserve deserves a lot of that blame. Moving on to a few other interesting bits of economic data, again, arming you for things you might hear during an election season. This is the size of our national debt. So there's 2 different ways to view it, and they're both legitimate for specific purposes. The blue line is the lower number, and that says we've got about $25 trillion in debt right now as a country. I think the better line is the black line, and that's the total size of the debt, and that's 35 trillion. And the difference between those 2 lines is simply this. There's privately owned, and then there's total owned U.S. Treasuries. Who owns the rest of those treasuries? Well, how could you get at a number of 25 trillion, not the real number of 35 trillion? That's the fact that the government owns a lot of its own debt. And who owns it? Well, the Federal Reserve owns some. And the other part that owns that is the Social Security Trust Fund, because that is a substantial vehicle. And what have they invested that in? Ever? Treasury bonds. So the government buys its own debt. So for all those decades where more money was being paid into the Social Security Trust Fund than was needed to go out that year, that excess was invested in treasuries. There's something else very interesting about this graph, and now we have to break each of these curves into 2 parts. And that's because the market value of this government debt is now meaningfully less than the face or par value of the debt. Well, what happens when the market value is worth way less? Who bought that at face value and is now sitting on all of those losses? Well, not our investors. To some degree, the Federal Reserve, within one other group. On this next slide, let me tell you who's lost a bunch of money by buying treasuries 3 or 4 years ago when rates were super low. Banks. So the chief investment officers at a lot of banks didn't serve their ownership especially well over the last few years. When they could only make 0.5% by buying short-term treasuries, in many cases, they chose to take a risk and go out and buy 5- and 10-year treasuries. Buying a 10-year treasury at 2.5% or 3% to get a little bit more yield, despite all the data that the Fed was going to have to raise rates massively, really hurt the banks. Now, you'll see what this is here is unrealized losses sitting on bank balance sheets, but you might not always see the numbers looking quite this big if you were to search for this data, because banks can hold these bonds where, again, they went out and bought $100 million worth of bonds, and now it's only worth $90 million because they locked in these really low interest rates. If they put them on their balance sheet as available for sale, that's what's in blue, that might be what's reported. But held to maturity means that they get to exempt these holdings from some of the financial tests, some of the financial reporting that is applied to banks. It doesn't really matter. You need to count them both. If you're an investor, imagine a few years ago, you went out and bought a 10-year treasury bond at 2%, but now the going rate is 4. You could sell that bond and take the loss and go invest at 4, or you can just hold on to that bond for the next 10 years, getting undercompensated and underpaid, only earning 2% when everybody else would be making 4. It doesn't matter. You're going to have to eat that loss one way or another. So you can just, take the pain and invest at a competitive rate, or just live with that bad decision until the bond matures. It's the same loss no matter what. They're just, for some reason, reported differently. So just be aware of the significance of the problem. If you have your money at a bank and it is beyond your FDIC limit, you've been warned. A lot of these bank closures that have happened in the last year have happened in a way where investors got fully covered for their full balance that was on deposit, not just was covered by the FDIC limits. And so, again, you've been warned. It's a huge risk. A lot of our clients have become aware of this risk, and we're now running treasury portfolios for them with a strategy we call short-term tactical. But for everybody listening, it's worth a quick examination. If you have money in a bank and it's beyond an FDIC limit, you're in theory a general creditor to the bank. And don't just assume that the FDIC is going to have the funds to rescue you if they have to step in to rescue your bank. And if your bank has also made a bunch of loans to, commercial real estate in terms of office space, there's probably some pain coming there as well. So these losses could go up dramatically, and surely there's going to be some banks that fail. And I wouldn't be shocked if some of those happen where investors with money over their FDIC limit do not get rescued. Couple quick more bits of data. In the spirit of bipartisanship and not taking a political position on things, I wanted to show you some data. And it didn't come from me. It comes from the bipartisan group, the Committee for a Responsible Federal Budget. These are the deficit hawks that you used to hear about, and you wonder where they are now. Well, they're all a lot of them are working for the Committee for a Responsible Federal Budget, the CRFB. What we're showing here is all of the actions that took place during the prior presidential administration under President Trump, and how these actions added to the increased size over the next 10 years for the national debt. So it's not always what it adds in that first year, but the projected increase over the next 10 years. And what you see is a number of actions that made the debt worse, and a lot of those were bipartisan. So just there's the data, interpret it how you want. I'd even suggest that it was the Trump administration grappling to deal with the COVID pandemic and what was going to be necessary to rescue the markets and the economy. We can look at the next page and see what's happened during the Biden administration, which of course has been a shorter term because that's just to date. But those actions, many of the actions taken, also add to the size of the national debt, at least where it's going to be 10 years down the road. And what you can see is that many of those were also bipartisan actions. And so the question on the table here again is, where are the deficit hawks? Because as we're going into an election, and we might all be attracted to proposals coming from both sides for tax breaks, whether it's a higher child tax credit, or it's not taxing tip income for tipped workers, such as your bartenders and your servers at your restaurants. All of those types of things are going to make the national debt go higher. So this is just really for your information. You can interpret it how you wish, but I'm anxious to hear from the deficit hawks out there and in their plans in politics. But there's not a lot being said about that these days. Now, I love this slide, and this is just meant to relieve some of the pressure as we got into the political arena a little bit. I would like to say that we started this slide looking at a number of gold orbs there. Each of those are pieces of data that we've shared with you, financial data, nuggets of things to consider. But what we're doing here is we're putting different colored lines in front of those gold balls. In other words, the balls are not changing color. It's just the context. It's just, are we putting a red line in front of it, a blue line in front of it, a green line in front of it? And as that happens, we see the balls as different colors. It's no longer just a set of facts on the page. It's no longer just an objective view. We're presenting you the objective view. What we know is that all of us leave a call like this and we go back and we interpret the world through a political lens. I don't think anybody's ever fully exempt from that. But these facts can look very, very different based on how they're presented to you. So the metaphor here is this optical illusion where all we ever showed you was the gold balls, but we can change the context a little bit and make any story look different, any data look different, in particular if it's a political point of view that you might agree with, right? So just a little lesson there for all of us as we're nearing the elections, that the same data can be framed very differently if you put a little bit of different context around it. Now, just to wrap things up, this is our infamous toolkit of things we can do for you. Hey, every advisor out there can figure out some way to invest your cash and your fixed income and your public equities. I think we do it better than most, and I've made that case a little bit. But not everybody knows how to use the options market to give you outcomes that might be even better. I love our hedged yield, I'll say in particular. And if any of you are invested in our hedged yield strategy, I would encourage you to go to your BIP client care webpage or your app if you've got that on your phone, which I think you should. That's a terrific idea. And go look at the returns you've achieved through your BIP hedged yield, and then go to the page where we show you what the fixed income benchmark has done. Because BIP hedged yield is synthetic fixed income. And if you look at those returns, whether you've had it for 3 months or 3 years or 5 years, and then you compare it to the fixed income index, what I expect you're going to see is a very large gap. So you're probably pretty happy that you've been using BIP hedged yield for some of your fixed income exposure. And then, of course, we love to talk about private fixed income. We love to talk about private equity. That's the arena of investing where the vehicle type is changing. And so there are new ways to invest there. And, if anybody's had private fixed income exposure, they love the fact that they've got a chunk of their portfolio that's probably pretty diversified and has been paying them double-digit yields. And they're probably interested in even more of it. It actually is really quite the game changer for us. We're having to figure out how to adjust to the fact that some of our clients have now pretty substantial parts of their portfolios that have been yielding 11, 12, 13, 14%, whatever it may be for their particular case, because a portfolio earning that much cash is generally not something that we were all trained for in the first parts of our career. But boy, it sure is nice to see. And then, of course, private equity. Private equity has just been a boon to the firm. It's been life-changing for so many of our clients. And again, I think probably a great time to consider, if you can do it in a tax-efficient way, taking money out of the public markets and putting it into the private markets, especially with some of these new vehicles where you can put money in when you want and ask for liquidity down the road when you need it. So we'll go ahead and just kind of wrap up here with some final thoughts. I'm really just summarizing what I said. But, when we talk about that toolbox, that's sort of the last big final thought here. Just remember that there might be things we can do for you that you've not talked about. One of the things that's a part of the toolbox now is that if you've got too much in one stock, we can run a concentrated stock strategy where we get rid of a lot of that volatility using options. Or maybe it's just our short-term tactical strategy. I think most of our clients have that now to some degree. If you've got money coming in and out of your life financially, maybe you've got plans for money in the future. You're going to buy more private market investing. You're going to buy a house. You're going to buy a car. A great way to keep that money pretty safe is with short-term tactical. Again, with U.S. Treasuries, we don't have to worry about FDIC limits. And so that's become a big part of the toolbox for a lot of folks. Just don't be surprised if your own personal wealth advisor is bringing new tools to your particular portfolio and asking you to take a look at why they think that that could serve you pretty well. Really, just a last couple of other thoughts here in an article I wanted to attach, and in these the next slide, you'll see this. I didn't write this next page that comes up. It's from one of the financial firms we work with sometimes, Dimensional Fund Advisors. They just wrote a interesting little article here where they talk about the big seven. And again, tech stocks have been kind of taking their lumps so far. This quarter, they're comparing the analyst forecast in 2022 and what the actual earnings forecast turned out to be. And in some cases, some pretty big gaps. Then they do the same thing in 2023. Again, surprises to the upside. Bill, if we get to the end of this year and it turns out to be a little bit more like 2022, there could be some nasty surprises out there. So just be careful about investing in what seem like are the best stocks, because boy, back at the end of 2022, we were seeing the decapitation of a tech stock rally, and with the way markets have been turning here just in the last few weeks, there's a possibility we're about to see it again. Thanks, everyone.